$2.3 billion. That is how much the Trump family has extracted from ordinary investors so far. And they aren't stopping. In fact, they're speeding up, even though the people who believed in them got absolutely wrecked. And now their single biggest backer is suing them in a California courtroom. The Trumps engineered a machine designed to capture every dollar of the upside while forcing investors to absorb every dollar of the downside. So today, we break down how that machine was built, why even the whales got played, and why this is a playbook that's been run 4 separate times. My name is Guy, and this is the Finance Bureau. Back in 2016, Donald Trump said something revealing. Quote, "The licensing deals are the best of all deals because there's no risk." And that sentence is the entire blueprint here. The Trump family bypassed investing entirely and simply sold access to their brand. They licensed their name, took revenue shares, and accepted equity stakes that, where ownership was reported, cost them precisely nothing. On the 9th of June 2026, Reuters published an investigation into 4 crypto ventures the family launched or expanded since the January 2025 inauguration. More than a dozen independent accounting and crypto experts reviewed the methodology and called the estimates reasonable. And the headline figure was staggering. Roughly $2.3 billion in profits flowed to the family, while across those same ventures, retail investors lost an estimated $2.3 billion. The numbers mirror each other almost exactly, and that is not a coincidence, but rather a wealth transfer from ordinary people to the family of the United States president. 8 government ethics experts told Reuters this is a conflict of interest unlike anything seen in modern American history. Because the same administration that regulates this industry through the SEC, the CFTC, and the Treasury is the same family profiting from it. Now, the 4 ventures in question are World Liberty Financial, the Trump meme coin, American Bitcoin, and a company called Alt5 Sigma. 4 launches, 4 collapses, but one repeating pattern underneath them all. And to see the pattern, you have to start with the template. So, let's begin with World Liberty Financial, because this is the blueprint that the other 3 copy. On paper, World Liberty is a DeFi lending protocol, a fork of an existing platform called Aave, bolted onto a stablecoin called USD1. Not an original piece of technology, in other words, but then the underlying tech didn't really matter because the entire project was about the financial structure. Now, when you bought World Liberty's WLFI token, what did you actually get? Well, you got governance rights, you got the ability to vote on protocol parameters, but you received absolutely no economic rights to the company's earnings or equity. The token gave you a voice and nothing else. Meanwhile, the cash flowed somewhere very specific. A Trump-controlled entity called DT Markets DeFi is entitled to 75% of the net proceeds from every single WLFI token sale. 75 cents of every dollar raised. And Donald Trump personally owns 70% of that entity. So, follow the money. You buy a token that gives you nothing but a vote, and 3/4 of your cash walks straight out of the door and into the arms of the Trump family.
Thank you.
And that vote is worth less than you might think, though if you did think it was worth anything, well, I have some interesting seafront property in Kansas City that you might be interested in. Anyway, the family and affiliated insiders hold 22.5 billion tokens out of a 100 billion supply. A governance vote in March 2026 revealed that 76% of all tokens that voted in that election came from just 10 wallets. And despite a square root voting formula designed to dilute large holders, the top wallets still commanded roughly 60% of actual voting power. So much for decentralization. Put simply, retail holders were perpetually outvoted by design. But it gets worse. Buried in the smart contract is an administrative freeze function, a backdoor that lets the team blacklist any holder's wallet without a court order and without notice. Now, take Hut 8, the mining company connected to American Bitcoin. Consider what happened there. Hut 8 bought $25 million of WLFI tokens shortly after American Bitcoin was created. Through that 75% mechanism, $19 million of that flowed directly to the Trump family. That is money circling out of one venture and into the pockets of insiders in another. This is circular value extraction, and it's happening in plain sight. Now, the stablecoin side does generate something real. USD1 has a circulating supply of around $4.6 billion worth, with reserves in cash and treasuries custodied by BitGo and managed by BlackRock. That interest income is a steady secondary revenue stream. And the venture is even seeking a federal trust bank charter from the OCC. So the defenders will say, look, this is real infrastructure, and we will come back to that argument because it deserves a fair hearing. But first, the structure claimed one more victim, the single biggest backer the project ever had. His name is Justin Sun. Now, Justin Sun is the founder of the Tron blockchain and a very well-known name in crypto circles, and he invested somewhere around $75 million into WLFI between November 2024 and January 2025. He was so important they named him a corporate advisor and gifted him another billion tokens. At the peak, his holdings were worth over $1 billion on paper. He was the whale, which you would think would make him the ultimate insider. And then, in September 2025, the project used that aforementioned freeze function to lock his wallet. Their justification was prohibited transfers and alleged short selling. His version, as you can probably imagine, is somewhat different. He says they used a hidden backdoor to strip his voting rights and threaten to burn his assets. By April 2026, he was in federal court in Northern California, alleging fraud, breach of contract, and conversion, with tens of millions of dollars of his position frozen. Holdings that had been worth over $1 billion at their peak, but had fallen to an estimated $43 to $75 million by the time the lawsuit was filed. He described the project as centralized finance in a decentralization costume and accused the team of treating the community as a personal ATM. The project countersued in Florida for defamation. Eric Trump and WLFI CEO Zach Witkoff dismissed Sun's allegations as entirely meritless. Regardless, though, if a man who put in $75 million, who sat on the advisory board, and who was the single largest outside backer of World Liberty Financial, couldn't get his money out, well, what chance did ordinary retail ever have? The whale got played, but while he has the lawyers to fight back, most other investors don't. And by the way, if you want to keep abreast of stories like this one that directly affect your portfolio, then you should be reading the Finance Bureau newsletter. It's absolutely free, and we break down everything regarding global finance, commodity markets, macroeconomic trends, and monetary policy so that you never miss what truly matters. All you have to do is click the link in the description or scan the QR code on your screen to get started. Right, let's now get back to the machine, because the World Liberty template was about to be wired straight into a publicly traded company on the NASDAQ. And that is where the whole thing turns into a financial time bomb. So this brings us to Alt5 Sigma, a small NASDAQ-listed company that later rebranded to AI Financial Corp. And while World Liberty showed us the template, Alt5 shows us what happens when you weaponize it on a public stock exchange. Here is the deal executed in August 2025. Alt5 sold $750 million of new stock to outside investors at $7.50 a share. It then used that money, plus its own shares and warrants, to acquire 7.3 billion WLFI tokens worth around $1.5 billion at the time. And because 75% of token sale proceeds flow to the Trump entity, this single transaction netted the family roughly $500 million. This turned the company's entire balance sheet into a single illiquid token holding. The stock became a leveraged proxy for WLFI's price. So when WLFI fell, the treasury was worth less, so Alt5 stock fell, which made it harder to raise capital, which forced more dilution and debt, which pushed the stock down further. A doom loop feeding on itself. Alt5 Sigma's stock collapsed from over $9 in August 2025 to around 66 cents by June 2026, a decline of roughly 93%. Retail losses from this single company, an estimated $675 million. In the first quarter of 2026 alone, the company posted a $271 million net loss, driven by a $348 million write-down on its WLFI holdings. By May, it had issued a going concern warning, flagging substantial doubt it could even survive. Now, compare this to Strategy, formerly MicroStrategy. When that company's Bitcoin bet sours, it has an escape valve because Bitcoin is deeply liquid and it can sell. Alt5 had no such valve. Its tokens are illiquid, locked up until August 2026, and controlled by the very counterparty it's indebted to. Because in January 2026, the company borrowed $15 million directly from World Liberty, collateralized by the very tokens whose collapse was killing it. Yes, you did hear that correctly. It borrowed from the entity whose asset was destroying it, using that very same asset as collateral. Meanwhile, the chairman of Alt5 Sigma, Zach Witkoff, is also the CEO of World Liberty. 3 CEOs cycled through, 3 auditors changed, one with an expired license, and Eric Trump was forced off the board to comply with NASDAQ rules. And now a NASDAQ delisting is looming. The structure was designed to fail for everyone except the insiders who cashed out at the top. And to prove this is a pattern and not a one-off, look at the fourth venture, American Bitcoin, which was founded in March 2025 by Eric Trump and Donald Trump Jr. alongside the crypto mining company Hut 8. Same playbook, new wrapper. Hut 8 holds 80% and all the voting control, while the Trump family holds the remaining 20%, acquired, once again, at zero monetary cost. The pitch was a next-generation Bitcoin mining and treasury company. Forbes called it something else, though, an arbitrage vehicle that preys on MAGA-minded investors. Roughly 70% of its Bitcoin was bought on the open market using money raised by diluting shareholders and not by mining. In a single quarter, the share count jumped 34%. The stock peaked around $14.52 and now sits at $4.61, down about 68%. Outside investors are down over $200 million since the NASDAQ debut. And Eric Trump? His zero-cost stake was still worth around $70 million as of April 2026, even as the stock cratered. His personal fortune reportedly grew from $190 million to $280 million in this period. Launch, hype, insider extraction, retail bag holding. 4 times. So, these aren't 4 isolated mistakes. This is a single machine run 4 times by people insulated from the downside. But let's be fair and steelman the other side of this, because there is a case to be made that they are building something real. USD1 is a genuine dollar-backed stablecoin with $4.6 billion in circulation and real commercial deployments. The underlying DeFi protocol is built on battle-tested technology. American Bitcoin runs real mining infrastructure with real hash rate. And the OCC Trust Bank Charter, if granted, would bring genuine regulatory oversight. The Trump brand did pull real liquidity and real attention into the crypto market. That is the strongest version of the defense, and Here is why it falls apart. Because every single mechanism we've walked through was structured so that insiders captured the upside, regardless of whether the project succeeded or failed. The freeze function turned a so-called decentralized protocol into a weapon the team could point at its own backers. The 75% revenue cut meant the family got paid the moment you bought, win or lose. The zero-cost equity meant they could never actually lose. And the near-perfect symmetry between their $2.3 billion in gains and retail's $2.3 billion in losses tells you exactly what kind of engine this was. A genuine business creates value. This one just transferred it. And the question of whether they built something real misses the point entirely because the building was never where the money was made. If you bought any of these tokens or stocks, you were the product being sold because think about what you were actually handed. Insiders took cash up front while leaving you with a governance token devoid of economic rights. They extracted value immediately, locking you into vesting schedules and freeze functions, and ultimately dumped the mark-to-market losses onto a public balance sheet as they walked away with their fees. In every case, insiders received cash or liquid equity, and you received something illiquid, locked, or just worthless. The asymmetry of liquidity was the asymmetry of outcome. Because people didn't buy in on a prospectus or due diligence. They bought a name. The most powerful political endorsement on earth became a substitute for financial analysis. And the moment that endorsement got treated as research, the trap was already sprung. Critics in Congress have called these ventures a wealth transfer that exploits retail investors, all while the regulators who might have stopped it answer to the very family that profited. The era of treating a political endorsement as due diligence has to end right here. These four ventures prove the structure was designed solely to monetize the belief of ordinary people. The insiders who took fees on the way in and never carried a cent of risk made out like bandits, while the believers confused tribal trust for a margin of safety. And for a crypto industry that spent 15 years fighting for legitimacy, this may be the most damaging reputational episode since FTX. Because the open question now is simple and unforgiving. When Alt5's token lockup expires in August 2026, either the company dumps and craters WLFI's price further, or it holds and may not survive. Either way, someone is going to be left holding the bag, and you can bet your life that not one of them is likely to have the surname Trump. But what do you reckon? Does the NASDAQ delisting clock run out before anyone gets real answers in court? Or does Justin Sun's lawsuit finally crack this structure open and expose exactly what was promised and to whom? Let me know your thoughts down in the comments below. That's all from me for today though, so as always, thank you for watching and I'll see you in the next one. This is Guy, signing off.